Something happened that should have been front-page news across the world, yet most Americans barely noticed it. Saudi Arabia announced it would accept Chinese yuan for oil sales to China, breaking a 49-year tradition of settling the world's most important commodity exclusively in US dollars. With that single shift, the petrodollar monopoly that had anchored American financial power since 1974 cracked open, and this shift was not an isolated trade deal. It was the unmistakable signal of Stage 6 in an 8-stage collapse pattern. The same cycle that has destroyed every global reserve currency in modern history. The Portuguese real fell in the 1600s, the Dutch guilder in the 1700s, the British pound in the 1900s. Now the US dollar is following the same sequence, step by step, driven by the same forces. Nations in power always believe they can defy. What people fail to understand is that reserve currency status is not a birthright. It is a cycle, an 80 to 110-year arc that has repeated with near mathematical precision. A currency rises on economic might. It dominates trade. It becomes over-leveraged. Competitors emerge. Confidence cracks. Alternatives rise. Crises accelerate. And eventually a new system replaces the old one. History records 3 full cycles. And in every instance, the leading power dismissed warnings because it believed its system was exceptional. They believed their financial architecture was too entrenched, too complex, too indispensable to ever fail. They were wrong every time. Today, the dollar stands in Stage 6, the phase where alternatives begin gaining undeniable traction. The petrodollar is weakening. BRICS nations are building payment networks outside the Western banking model. Parallel institutions, from new development banks to currency swap lines, are scaling rapidly. Based on patterns visible in previous collapses, the United States has perhaps a decade, or slightly more, before the dollar loses its dominant reserve status. Not disappears, reserve currencies rarely vanish, but falls from global necessity to global option. And when that happens, the consequences will be transformational. America's ability to print money and export the inflation abroad will disappear overnight. The $36 trillion national debt, once manageable through cheap borrowing, will become a crushing weight. Interest rates will rise not because the Federal Reserve chooses it, but because global investors demand it. And a nation accustomed to artificially elevated living standards, subsidized by foreign demand for dollars, will experience a 30 to 40% decline in real purchasing power. This may become the most consequential economic story of this century, yet public awareness remains shockingly low. To understand why the system is unraveling, you must examine the 8-stage pattern that has governed previous collapses. This is not speculation, but pattern recognition, a historical rhythm playing out again with eerie consistency. Before diving into the stages, it is essential to understand what a reserve currency actually is. It is the currency that nations hold as their primary foreign exchange reserves, used to settle trade, pay international debts, and stabilize domestic markets. When a currency becomes the global reserve, the issuing nation gains tremendous advantages. The first advantage is on its structural demand. Nations must hold the reserve currency to trade globally, creating constant demand that supports the issuer's economy regardless of its fundamentals. The second is seigniorage, the ability to print money and exchange it for real goods, an economic privilege so enormous that few societies recognize how much it distorts their prosperity. The third advantage is cheap borrowing. When the world demands your currency, it also buys your government bonds, lowering borrowing costs far below what domestic conditions alone would justify. The fourth is exported inflation. Money creation spreads its inflationary effects across the globe instead of concentrating them domestically. These privileges define reserve dominance, but losing them is devastating. When the world no longer needs your currency for trade, demand collapses. You can no longer borrow cheaply or print with impunity. Domestic inflation appears immediately instead of being diluted internationally. Living standards fall back to what the nation's real economic productivity can sustain, not what financial privilege once made possible. This is exactly what happened to Portugal, the Netherlands, and Britain, and the early stages of this correction are now beginning in the United States. The cycle always begins with stage 1, dominance established through overwhelming economic and military superiority. A currency becomes the global reserve because the issuing nation has the most powerful economy, the most advanced financial infrastructure, or the most formidable military protection. This creates trust, not sentimental trust, but structural confidence that the nation can enforce stability. Portugal in the 1500s controlled the spice trade, the most lucrative supply chain on Earth. Its naval forces dominated the passage around Africa, and its fortified ports Goa, Malacca, Macau were strategic choke points for commerce. The Portuguese real became the essential currency of Asian trade, because merchants needed it to access goods that were more valuable than gold by weight. The Dutch Republic in the 1600s built the world's most efficient commercial engine. Amsterdam became the global hub of trade. The Dutch East India Company, the richest corporation in human history, controlled routes from the Baltics to the East Indies. The Dutch financial system was unmatched. The Amsterdam Stock Exchange, the first true stock market, and the Bank of Amsterdam, the era's most trusted institution. The guilder became the reserve currency because Dutch markets were liquid, transparent, and stable. After defeating Napoleon, Britain emerged as the central power of the 19th century. The Royal Navy controlled the oceans. British manufacturing dominated global industry, and the empire encompassed a quarter of the world's population. The gold-backed pound became the anchor of international trade. By the early 20th century, most global invoices were denominated in pounds because Britain's financial system was the backbone of global commerce. Then came the United States. After World War II, America possessed half of global GDP. Its industrial base was untouched. Its military was unrivaled. And the Bretton Woods system made the dollar convertible to gold, positioning it as the ultimate foundation of global finance. Even after the gold window closed in the early 1970s, the Petrodollar agreement with Saudi Arabia preserved America's dominance by ensuring global energy trade flowed through the dollar. But dominance contains the seeds of its own decline. The privileges of reserve status encourage debt, overextension, complacency, and political decisions that would be impossible without the safety net of global demand. Nations mistake temporary privilege for permanent entitlement. They forget that the rest of the world tolerates their dominance only as long as it remains beneficial, or at least unavoidable. The cracks now spreading through the system are not sudden disruptions, but the natural next phase of a centuries-old cycle. Competitors are rising, confidence is eroding, and alternatives are scaling. The dollar's fall is not about ideology or wishful thinking from rival nations. It is simply what happens to every currency that reaches this stage of the historical pattern. The transition may take years, but the direction is clear. The cycle is entering its most dangerous phase, and history suggests the pace will only accelerate from here. The world is moving, quietly but powerfully, toward the next reserve currency era. And the United States must confront a reality every prior empire has faced. Dominance does not last forever, and the bill for decades of privilege always comes due. Stage 2 of the cycle is the moment when a dominant power reaches its peak while simultaneously planting the seeds of its own decline. At the height of its influence, the leading nation typically overextends militarily, financially, politically. It fights wars it cannot afford, borrows far beyond its productive capacity, and prints money to sustain global commitments. During this period, the currency remains strong, not because fundamentals justify it, but because global inertia keeps demand high. The rest of the world still needs the currency, so the imbalance remains hidden, often for decades, until the gap between power and reality grows too large to ignore. Portugal reached this phase when it controlled nearly the entire Indian Ocean. Spice trade. Despite its wealth, it suffered from a structural weakness, a small population of barely 1 million people, attempting to maintain dozens of military outposts from Mozambique to Macau. Portugal tried to project force across continents, with a manpower base smaller than many modern cities. Wars against rival European powers drained treasury resources, and maintaining fleets, garrisons, and colonial administrations required levels of investment the kingdom could no longer sustain. To keep the empire afloat, Portugal borrowed heavily from Italian and German bankers. By the mid-16th century, debt service consumed the majority of royal revenue. Yet the real stayed strong because the spice monopoly kept global traders reliant on Portuguese routes. The empire looked powerful from a distance, but underneath was a structure buckling under its own weight. The Dutch Republic experienced a similar overextension. At its peak, the Dutch controlled global shipping and operated the world's most advanced financial system. But they became embroiled in multiple conflicts with England and France. These wars were enormously expensive for a nation whose economy relied on trade and finance, not large-scale militarized land campaigns. The Dutch East India Company remained profitable, but competition from the English East India Company increased each year. By the turn of the 18th century, Dutch defense spending had outgrown the economic returns of their trade network. Debt soared. But the guilder remained the world's preferred reserve currency, because Amsterdam's financial markets were still the most trusted. As with Portugal, dominance masked structural fragility. Britain's moment of overextension came when it controlled the largest empire in human history. By the late 19th century, however, rising competitors emerged. Germany industrialized rapidly, and the United States surpassed Britain in GDP before the century ended. The Boer War alone absorbed a massive portion of British economic output and exposed how expensive it had become to enforce imperial rule across vast territories. Maintaining the largest navy in the world strained government finances even more. Britain continued borrowing to preserve global dominance, a pattern that intensified during World War I. By the outbreak of the war, Britain had transitioned from the world's largest creditor nation to a debtor dependent on American financing. Yet the pound remained dominant because global systems still revolved around London. The United States followed the same trajectory. After World War II, it had no peer competitors. But decades of military interventions from Vietnam to Iraq and Afghanistan became increasingly expensive. These conflicts compelled the government to print money and issue debt on an unprecedented scale. The Vietnam War directly contributed to the end of dollar convertibility to gold, a turning point that severed the last anchor of monetary discipline. Even so, the dollar's dominance persisted because no viable alternative existed. The Petrodollar agreement entrenched structural demand. Nations needed dollars to buy oil, regardless of America's growing debts. By the early 21st century, the United States had accumulated trillions in obligations, but remained shielded by the inertia of the global financial system. Stage 2 is always the same. A nation expands beyond its ability to sustain itself, while the world continues relying on its currency out of habit, not strength. The downfall begins in Stage 3, when competitors quietly start building alternative systems. Rising powers never attack the dominant reserve currency head-on. Instead, they create defensive mechanisms to reduce their vulnerability. Vying powers watched Portugal overstretch and responded by founding rival trading companies. The English East India Company and Dutch East India Company introduced more efficient ships, better financing, and more organized networks. These alternatives cracked Portugal's monopoly. Within decades, the Dutch controlled most of the spice trade. The real still circulated, but it was no longer irreplaceable. A similar pattern unfolded with the Dutch. As Amsterdam dominated global finance, Britain built competing financial institutions. The Bank of England offered stability and credibility, and London's markets began attracting international capital. France attempted to develop its own financial hubs. By the mid-18th century, British trade volume exceeded Dutch trade. The guilder still functioned globally, but the pound was rising in parallel. The transition from British to American dominance followed the same script. World War I devastated British finances, forcing it to borrow heavily from the United States. America's economy grew larger, and its financial infrastructure strengthened. The Federal Reserve and New York banking networks emerged as credible alternatives to London. The pound remained the reserve currency, but the dollar steadily gained global influence. In the modern era, the pattern reappeared after the 2008 financial crisis exposed vulnerabilities in the dollar-based system. China accelerated the development of the CIPS payment system as a partial alternative to SWIFT. Russia built SPFS, its own messaging system. BRICS nations began discussing a shared currency framework. None of these institutions were designed to immediately overthrow the dollar. They were created to protect against the possibility that the United States might weaponize its currency. And that brings the cycle into Stage 4, currency weaponization, an accelerant that speeds the rise of alternatives. The dominant power, feeling pressure from competitors, uses its currency as a geopolitical tool. It imposes sanctions, freezes assets, and excludes adversaries from global payment networks. Yet this behavior always backfires. Targets of sanctions rush to build independent systems, and neutral countries begin hedging out of fear. They may one day face similar treatment. Portugal provided an early example when it attempted to restrict Dutch and English traders from its ports. Rather than preserve Portuguese dominance, the move pushed rivals to establish their own fortified hubs, such as Batavia and Madras. Once competitors built parallel systems, Portugal's monopoly collapsed. Britain used its naval supremacy during the Anglo-Dutch conflicts to blockade Dutch ports, crippling their trade. Instead of reinforcing reliance on Amsterdam, merchants shifted their business to London's banks, accelerating the guilder's decline. Later, during World War I, Britain froze German assets, signaling that London was no longer a politically neutral financial center. After the war, neutral countries diversified away from pounds, reducing Britain's influence. The United States' use of financial sanctions represents the most dramatic modern example. Sanctions against Russia after Crimea pushed Moscow to reduce its dollar reserves and increase gold holdings. But the decisive turning point came when the United States froze hundreds of billions in Russian central bank assets after the invasion of Ukraine. For nations worldwide, this set a precedent. Dollar reserves were no longer untouchable. A country could lose access to its wealth at Washington's discretion. The reaction was immediate, rapid diversification out of dollars, reduction of U.S. Treasury holdings, and major investment into gold, local currencies, and new payment systems. In every historical cycle, Stage 4 marks the irreversible tipping point. Once a dominant currency becomes a political weapon, its decline accelerates. Alternatives stop being optional and become necessary. And the moment the world realizes that its reserves can be frozen overnight, trust in the system vanishes, and the fall moves to its next stage. As countries watched the United States weaponize the dollar, they began moving aggressively to protect themselves. Saudi Arabia reduced its dollar exposure from overwhelming dominance to a still large but significantly lower share. Central banks around the world bought historic volumes of gold, hundreds of tons collectively, within just a few years levels not seen since the 1970s. Nations began building parallel payment systems to reduce their dependence on SWIFT. What was intended as punishment for Russia instead convinced the entire non-Western world that relying on the dollar was a strategic vulnerability. This is the essence of Stage 4. Weaponization does not strengthen the dominant currency. It accelerates the search for alternatives and speeds de-dollarization. Stage 5 begins when confidence cracks and the reserve share visibly declines. After a currency has been weaponized, the fear of seizure or exclusion drives countries to actively reduce their holdings. It is not sudden collapse. It is a long bleed that becomes irreversible once it starts. Historically, this stage often lasts a decade or more, sometimes up to 30 years. But every step is a one-way door. Portugal's decline unfolded slowly. Once Dutch and English trading networks formed, merchants gradually reduced their reliance on the Portuguese real. Over several decades, the real's share of Asian trade slipped from dominance to marginal relevance. Once confidence faltered and alternatives existed, traders migrated to currencies with broader networks and better liquidity. The real became confined to Portuguese-controlled territories. The Dutch faced the same trajectory. After British blockades crippled Dutch trade, the guilder's reserve share collapsed. Wars, financial disruption, and the loss of colonial holdings shattered Amsterdam's banking system. In just over a generation, the guilder went from the backbone of European finance to a currency of regional importance. The Napoleonic Wars dealt the fatal blow, ruining Dutch trade and physically occupying the Netherlands. Britain's fall was faster. World War I shattered its finances. Sterling was already weakened by wartime borrowing, and when peace returned, the world no longer relied on Britain as the anchor of global trade. Sterling reserves declined steadily. Within a few decades, the pound dropped from majority reserve currency to a secondary asset. Bretton Woods merely formalized what the market had already decided. The dollar was now the center of global finance. The dollar followed the same pattern, just on a larger scale. Its global share peaked around the turn of the millennium. Since then, It has fallen gradually but consistently. Even modest declines are significant, because reserve currency dominance is about confidence. Once the curve bends downward, it rarely bends back up. The last few years have shown a particularly steep decline as nations actively seek alternatives. If the current trend continues, the dollar will drop below the symbolic threshold of 50% soon, signaling to the world that the system is no longer anchored by a single currency. Stage 5 is the quiet part of the decline, visible, steady. Stage 6 is the inflection point when alternatives reach critical mass and network effects flip. Traditionally, the dominant currency benefits from strong network effects. The more people use it, the more valuable it becomes for everyone else. But that same mechanism works in reverse. When enough traders, central banks, and financial institutions begin using alternatives, it becomes easier to avoid the dominant currency than to use it. Merchants prefer currencies accepted by their customers. Banks prefer platforms that reduce political risk. Investors flock to systems that offer more autonomy. Once that flip happens, the decline accelerates. This phenomenon has repeated across centuries. Dutch and English trade networks eventually outclassed Portugal's, offering better financing, more reliable shipping, and wider access to global markets. Merchants gravitated toward the guilder. The real did not disappear overnight, but its global relevance evaporated once network effects turned against it. The Dutch then suffered the same fate at the hands of Britain. London's markets grew larger, deeper, and more trusted. The Bank of England offered more credibility and stability than Amsterdam's banks. The combination of military strength, financial innovation, and global trade made the pound the logical choice for merchants. The guilder shrank to a regional currency. Britain then faced its own reversal. World War II destroyed its economy. The pound was devalued. The empire fractured. The Suez Crisis exposed Britain's dependency on American approval. When the United States threatened to collapse the pound unless Britain withdrew, it became clear to the world that sterling was no longer independent. From that moment on, the network effect cemented the dollar as the global standard. Today, the world is witnessing the same pivot. The moment Saudi Arabia accepted yuan for oil, the first break in the petrodollar system, the psychological shift began. Saudi Arabia joining BRICS signaled a broader realignment. China's CIPS payment system has scaled rapidly, processing trillions annually. BRICS nations are discussing commodity-backed currency structures. Bilateral trade deals in local currencies are increasing. Even energy producers, once fully aligned with the United States, are exploring alternatives. The metric that matters most is trade invoicing. When the share of global transactions conducted in dollars falls sharply within just a few years, it reflects a change not just in policy, but in behavior. Merchants are choosing to bypass dollars because their partners are willing to do the same. That is the network effect flipping in real time. Stage 6 is underway. Stage 7 is the crisis stage, the moment when long-term decline collides with a sudden shock. Every currency that faces this moment experiences panic diversification. A war, financial crisis, or policy bomb error triggers the unraveling. Countries dump reserves quickly. The currency plunges in value. The dominant power tries to defend it, but faces no good options. Raise rates aggressively and risk severe recession, or print money to stabilize the system and trigger inflation. History is full of examples. Portugal's final collapse followed the War of Spanish Succession, when its ports were blockaded and its Asian trade evaporated. The Dutch fell into irrelevance after repeated conflicts left their financial system crippled. Britain collapsed after World War II with debt far exceeding its economic output. The pound was devalued. The empire dissolved. The dollar's crisis could be triggered by several factors: a successful BRICS currency launch backed by commodities, a U.S. debt spiral that destabilizes bond markets, a multi-front geopolitical conflict that exposes military overstretch, or a systemic banking crisis caused by commercial real estate defaults. Any of these could push global investors into panic diversification. A rapid drop in the dollar's value would follow, forcing the Federal Reserve into impossible choices. This is stage 7, the moment the decline becomes visible to everyone. Stage 8 is the aftermath, when a new reserve currency emerges, not instantly, but gradually, as global markets converge around a new standard with better networks, greater credibility, and stronger support from major economies. The cycle moves on, and a new currency becomes the backbone of global trade for the next era. The old currency usually continues to exist after losing global power, but only as a domestic unit. The Portuguese real, for example, slowly ceded international dominance to the Dutch guilder. By 1680, global trade relied primarily on guilders, while the real survived only inside Portugal. The same pattern repeated when the British pound overtook the guilder. By 1815, the pound was the main settlement currency for world commerce, even though guilders remained in Dutch circulation. A similar transition happened in the 20th century. Bretton Woods in 944 formally designated the dollar as the global reserve currency. Yet the process was not immediate. As late as 1950, the pound was still widely used in trade. Only by 1960 had the dollar become unmistakably dominant, and by 1970, the pound had slipped into secondary status. Today, the successor to the dollar is not yet clear, but there are 3 reasonable contenders. First, the Chinese yuan. If China continues expanding its economy, and if CPS becomes the preferred global payment network, the yuan could ultimately replace the dollar. Yet significant obstacles remain: capital controls, opaque financial governance, and an authoritarian system capable of freezing assets at will. Second, a multipolar currency structure. The dollar, euro, and yuan could coexist as regional reserve currencies, with no single hegemon. Third, gold, or a gold-backed currency. If a BRICS currency emerges with credible backing from gold and commodities, it could provide a politically neutral settlement standard. Whichever system replaces the dollar will be determined by stability, liquidity, and trust, 3 pillars that every reserve system must satisfy. But the decline of the petrodollar is unfolding differently and far faster than previous transitions. Earlier reserve currency turnovers took 50 years from peak to final replacement. The dollar's transition is on track to unfold within 30 years, roughly from its peak around 2000 to a probable handoff between 2030 and 2050. Several forces accelerate this shift. First, technology compresses time. In 1914, moving gold between nations required ships, railways, and weeks of travel. Today, billions in reserves can be repositioned instantly through digital systems. De-dollarization can occur in minutes, not decades. Earlier transitions were slow because physical logistics were slow. Digital finance removes that friction. Second, viable alternatives already exist. In the 1940s, as the pound declined, The dollar was the only economy large enough to assume reserve status. Today, countries have multiple options: yuan, euro, gold, BRICS currency, even cryptocurrencies. Nations can diversify immediately. They do not need to wait for an alternative system to mature. Third, the petrodollar was artificial. Previous reserve currencies, the real, the guilder, the pound, were supported by real economic foundations, trade dominance, industrial output, and sophisticated financial markets. The petrodollar system, established in 1974, depended on a political agreement with Saudi Arabia to price oil exclusively in dollars. Once that political foundation weakens, the system unravels quickly. Saudi Arabia is already realigning, accepting yuan, joining BRICS, and broadening global partnerships. Because the petrodollar depended on a single bilateral arrangement, its vulnerability was built in. Fourth, the debt is unprecedented. Portugal, the Netherlands, and Britain all suffered debt strains during their declines, but none faced anything comparable to America's $36 trillion debt, over 120% of GDP. When the dollar relinquishes reserve currency status, the U.S. can no longer easily finance deficits. Interest rates spike. The government must choose between austerity or inflation. Earlier reserve powers had time to manage gradual decline. America does not. Its sheer debt load forces an accelerated adjustment. Fifth, globalization spreads crises instantly. In the 1940s, a British currency crisis affected mainly the empire and several trade partners. Today, a U.S. currency crisis shocks the entire world at once. Over $80 trillion of global debt is denominated in dollars. Foreigners hold $13 trillion in U.S. treasuries. The U.S. money supply alone stands at $21 trillion. A break in confidence would trigger immediate worldwide selling pressure. Earlier transitions were regional. This one is global, faster, sharper, and more chaotic. Now let us map the timeline using historical patterns. 2000-2008, peak dollar supremacy. Reserve share at seplet. Petrodollar unquestioned. Military unparalleled after the Cold War. This corresponds to stage 2, peak power. 2008-2000, the financial crisis shakes confidence. China builds SIPs. Nations begin questioning the safety of dollar reserves, though no alternatives exist yet. This aligns with stage 3, competitors preparing alternatives. 2014-2022, Russia's 22 sanctions and massive money printing in 20 intensify global concern. Russia dedollarizes. China expands its payment networks, but the system still holds. This is stage 4. Weaponization begins. 2022-2023, the cutoff of Russia from SWIFT and the freezing of $300 billion in reserves marks a historic turning point. Nations realize dollar reserves can be seized. De-dollarization accelerates. Saudi Arabia accepts yuan in March 2023, breaking the petrodollar monopoly. This is the shift from stage 4 to stage 5. 2023-2025, dollar reserve share drops from 60% to 58%. Trade share falls from 6 to 15. Central banks buy over 1 tons of gold annually. BRICS expands to 9 members. SIP's volume doubles. This is stage 5. Confidence cracking as alternatives scale up. 20-30 BRICS currency likely launches around 2020. More nations settle oil in non-dollar currencies. Dollar reserve share slips below 50%. Trade share also below 50%. Network effects. Reverse using alternatives becomes easier than using dollars. This is stage 6. 2030-2035, a crisis triggers panic. Possible catalysts include a BRICS currency breakthrough, debt event, military overreach, or a banking failure. The dollar could drop 30 to 50%. The Fed faces a brutal choice: print and inflate, or tighten and cause depression. This is stage 7, crisis acceleration. 2030-2050, a new monetary order crystallizes yuan dominance, a multipolar system, or a gold-backed BRICS currency. The dollar remains significant, but no longer the world's reserve anchor. This is stage 8, full replacement. The timeline can shift faster if a major shock arrives, slower if the U.S. successfully defends its influence. But the trajectory is clear. The dollar is weakening, and its descent is accelerating. Who benefits? Gold holders win dramatically. Every reserve currency collapse has driven massive gold appreciation. Between 1940 and 1960, as the pound fell, gold rose from its $30 official price toward the explosive rally that reached 80 by $80, a 24% increase. After the dollar left gold convertibility in 1971, gold surged again, from 30s to around 8 by 1980. 23. BRICS nations win as well. China, Russia, India, Brazil, South Africa, and new members such as Saudi Arabia, the UAE, and Iran gain economic independence from dollar-dominated financial structures. They can finally trade in multiple currencies, diversify their reserves, and choose assets that are insulated from sanctions or unilateral pressure. Their geopolitical weight grows as U.S. leverage shrinks. Commodity exporters also benefit. When oil, gas, metals, and food can be priced in several reserve currencies instead of only dollars, the balance of power flips. Exporters gain bargaining strength. They can negotiate better terms, choose currencies that preserve value, and avoid the strategic vulnerability of relying on a single system. Saudi Arabia's willingness to accept yuan is a decisive example. Its position in global energy markets now gives it leverage rather than dependency. Countries with low debt enter this transition from a position of strength. Switzerland, Norway, Singapore, and Germany become magnets for capital-seeking safety. Their currencies appreciate as investors flee dollar erosion, and their fiscal discipline becomes a competitive advantage. These nations are not just avoiding the damage. They are positioned to capture the capital and influence that shift during reserve transitions. But America loses the most. For half a century, the U.S. economy has been built on the privilege of printing dollars to acquire real goods, resources, and labor from the rest of the world, consuming more than it produces. Once the reserve privilege ends, this artificial boost evaporates. The enormous trade deficit becomes unsustainable. The U.S. must import less, export more, or both. That translates into fewer goods on shelves, higher prices, and reduced consumption. Living standards fall, not all at once, but steadily, predictably. Analysts estimate a 20–30% decline in American living standards over the transition period. Dollar savers. People holding cash. Treasuries, or dollar-denominated portfolios, are hit directly. A 30–50% decline in global purchasing power means a $1 million treasury portfolio suddenly behaves like 7. Even if domestic inflation is suppressed through price controls or subsidies, international purchasing power collapses, which is what matters for global trade and capital flows. Developing nations with dollar-denominated debt also lose. With $13 trillion owed in dollars, they face a double threat. If the dollar temporarily strengthens before collapsing, their debt servicing becomes unbearable. But if the dollar collapses later, their export revenues fall in real terms while their debts remain fixed. Either scenario is toxic. Many emerging markets will be forced into restructuring, default, or painful austerity. Wall Street loses its global supremacy. The U.S. financial system's dominance relies entirely on the dollar's centrality. If global trade and capital flows move toward the yuan, the euro, or a BRICS-backed commodity currency, financial clearing shifts to Shanghai, Frankfurt, or Dubai. That means lower transaction volumes, shrinking banking margins, and declining influence. New York's status as the world's financial capital begins to fade. The U.S. government faces the harshest consequences. Today it borrows trillions annually, with foreigners absorbing a significant share by buying treasuries as reserve assets. Once countries no longer need dollar reserves, that foreign demand evaporates. To finance deficits, the U.S. must either print money, triggering inflation/spending politically impossible, or raise taxes economically destructive. None of the outcomes are painless. A massive wealth transfer begins from dollar-based assets to non-dollar assets, from indebted nations to resource-rich nations, from the U.S. to the BRICS sphere. It could be the largest wealth reallocation in modern history. And this leads to the central point. The 8-stage reserve currency cycle has repeated 3 times over 5 centuries. Each dominant power believed it was immune. Each believed its institutions, its empire, or its economy made its currency irreplaceable. They were all wrong. Decline was slow to begin, but once underway, it never reversed. The US dollar is deep into stage 6. Alternatives are gaining critical mass, and the petrodollar system that held the dollar's dominance together for 50 years has already fractured. When Saudi Arabia accepted Yuan.For oil, it was not merely a symbolic gesture. It broke the network effect that maintained dollar supremacy. When the world's largest oil exporter sells outside the dollar, it announces to all other nations, "You have options now." Once that message spreads, the shift accelerates. Historical cycles and current acceleration suggest a roughly decade-long window before the dollar loses its reserve crown. Not disappearing, but stepping back into a multipolar world where it shares influence instead of monopolizing it. A world where the dollar holds 35–40%, the euro around 20%, the yuan around 20%, and a gold or commodity-backed BRICS currency another 15–20%. Not one dominant currency, but several competing centers of gravity. When that happens, America's 50-year free lunch ends. The ability to create money and exchange it for real global output evaporates. The immense national debt becomes manageable without painful adjustments. Living standards fall. It already happened to Britain a century ago. It is unfolding again, only faster, because globalization and digital finance compress timelines that once stretched across generations. The pattern is laid out. The stages are recognizable. The U.S. is already deep in stage 6. The collapse is not a sudden event. It is a progression, a sequence, unfolding exactly as history says it should. Not today, not tomorrow, but inevitably. If this documentary revealed a pattern you never knew existed, if you now see how reserve currencies rise and fall with remarkable consistency, then stay with me. Because over the coming decade, I will track every BRICS development, every de-dollarization milestone, every signal that Stage 7 is approaching. The petrodollar era is ending. The 8-stage cycle is repeating. History does not repeat itself perfectly, but it rhymes. And right now, the rhyme sounds unmistakably like Portugal in the 1600s, the Netherlands in the 1700s, and Britain in the mid-1900s. The dollar's era is closing. The transition is underway. Position us accordingly.